The options before a small investor are plenty. The choices are literally so much that making a choice itself is now becoming more and more interesting. Once in 10 years.
In the sense, yeah, she can afford to
people
take
who
that
got once in 10 hours.
10 minutes also, but
Okay.
it's not going to do anything. There's going to be no magic. And if she's not very confident, she should consult a distributor because she's still too early for an RIA.
How does a person decide whether he should go to these four people or go to a guy who's a fifth guy who is a distributor?
There is a big difference between generic advice and specific advice. I can change my mind tomorrow. I am free. Remember that. I am free, so I can change my mind. I can do a post saying why you should invest in an index fund. I can do a post why you should not invest in an index fund. What will you do with both the advice?
And what should they expect from the distributor?
When you say 1.5%, it looks ridiculously high when the corpus is 10 crores. But at 5,000 rupees a month, it means 75 rupees. In a year, it means 900 rupees. Believe me, in absolute terms, that's not a killer.
Now, what about the school of thought? Ditch this index, that's for babies. Ditch mutual funds, they are for people who don't have high return appetite. Straight, the big game, let's play stocks.
In 2000 boom, if you had bought Wipro, which is a great company, no doubt about that, you wouldn't have made money till maybe 2015.
Why? Tell me why.
Simply because you got the timing completely wrong.
Why can't I buy the Levers and the Nestle's and the Pidilites and the Asian Paints of the world? And do you think that the Wipro thing can recur?
Because this company has done nothing last 3-4 years, so the momentum players are not talking about it. Nobody wants to talk about it.
They will try to find something else.
They will be finding something else, and that time you wonder saying, oh, everybody got out, I made a mistake, let me get out. So you make two mistakes, buying at a high and selling at a low.
So buying stocks at any price, which now is called BAP, buy at any price, is a risk in direct equity. What can go wrong for somebody who thinks I have the tools and I have done it?
People like me have seen 1993 when my income fell 95%. My portfolio was wiped out. Company doesn't know you. Don't get emotionally attached.
Subramanyam, in this video we are going to give a 360-degree view of small investor investing. Somebody who's just starting to invest. Where should he first begin? The reason I ask this question is the options before a small investor are plenty. He can go and buy even one share in a company by having a zero brokerage account. He can go and buy a small case. He can go and buy a mutual fund. He can go and buy an ETF. He can go and buy global ETFs. He can do so many things, right? And the choices are literally so much that making a choice itself is now becoming more and more interesting. So a small investor has huge opportunity before him. How should he start? Where should a small investor begin? What's the first step a small investor should take?
Okay, when you're saying small investor, I am translating it to young investor. Not just a small investor,
yes,
young
somebody
investor.
who's sub 30.
Sub 30, 24, 25, just started to earn. If he comes from a rich background, like rich parents and all, he should invest in startups with his friends, etc. Because this is the age when you are willing to take any risk. So he should look at those options if he comes from a wealthy background. Let's say the parents are doing well, father is a doctor, mother is a professional and they have nice net worth. They're not really dependent on his income.
Okay.
So he should look at all those options and maybe 30, 32, he finds it works, doesn't work, whatever, he can come back and correct the actions which he has taken. Course correction is possible. But if it's a young boy or a young girl on whom the family is dependent, let's say she's the daughter of a father who is retired and mother is a housewife, so her income is important. The first thing she should do is take term insurance. She should ensure that the family has adequate medical insurance. These are the basics. Without this, you should not even move because something could go wrong. Right? So she should take those things and then she should start. If she has no knowledge, and I'm assuming because she's from such a background, her parents have never invested, they've never gone beyond a bank deposit, she should start with an index fund, a dull, boring index fund.
So that's the first starting point.
First starting point. When she has not learnt anything, she should go with her mother or father to the AMC office. And I'm very clear, it should the
No,
AMC
they can do
office,
it online today.
or they can do it online. They should do their
Don't suggest
KYC.
going anywhere and all. They'll do it online.
Correct, they can do it online. If she is tech savvy enough, she can do it online. She need not go through anybody. She can go and put money in an index fund. Start with as small as 500 or 1000 rupees, depending on her capacity. That's where she should start. Then she should start learning about. Once she starts investing, she will say, why is that fund doing better? Why is this fund not doing well? What is small cap, mid cap, large cap? She should start learning. Once she learns, she can then increase the size of her portfolio. She can then maybe stop this, do a large and mid cap, small cap, whatever. Or if she's doing 5,000 in this, she can stop this, or maybe do this of 2,000, do 1,000 mid and large cap, 1,000 in small cap. She can have a slightly diversified portfolio.
So you're saying after this index fund, the next is the large cap.
Yeah, she will learn, right? So she will
Mid and large cap.
realize.
You're asking them to move to
slightly more aggressively managed funds, because you should not feel that why am I in this.
There you're suggesting diversified funds first.
There
not
you go for
thematic or
no,
not a
thematic,
small cap and a mid cap and all
she's too young and early to go into funds where she can lose a big part of her capital.
So you said 500,000 or whatever, even let's say 5,000 for the index. Even if let's say a person has 20,000 savings, I'm just assuming 5,000 for the index. How much can he or she put into the next one, which is the diversified fund?
So again, assuming that she is from a first level
Let's
investor,
talk for the level one investor.
Yeah, so she should also build her own emergency fund. If
Okay,
the
that's
father
the third
doesn't
fund.
have, but if the father has fixed deposit, let's say a father has 5-10 lakhs of fixed deposit,
The
you
self-reliant person should have a contingency.
should have a contingent fund. Or if a father has a contingent fund and she's staying with her father, she's 23 years, she's not married, so that father's contingent fund can be there for the family.
Alright.
Then
How
first
many months of
5,000
her income should this contingent fund be? How many months of her income?
more than months of income, I would say months of expenses.
Okay,
So
months
if
of
her,
expenses.
if her monthly expenses or for the whole family is about 10-12,000, she should have say 70-75,000.
6 months.
At least 6-7 months expenses
Right.
she should have in bank deposits. Simple bank deposits are good enough.
Okay.
Right? So that's where she should be. Her term insurance is in place, her medical insurance is in place, her index funds are in place. She should be very clear that she should look at her index fund once in 10 years.
Once in 10
In
years.
the sense, she can afford to
People
take
look
that
at
hit.
once in 10 hours.
10 minutes also, but
Okay.
it's not going to do anything. There's
Okay.
going to be no magic.
Right.
She should look at it maybe, but she should act on it maybe once in 2-3 years. Once in 10 years is an exaggeration, but she should look at it with a 10-year view.
Right. And what about the second one?
Second, she goes for a large and mid cap, or if she feels there is see, by this time she has learned. So she knows what to look for in a fund, and she realizes that this is large cap, so let me go for a mid cap fund, or let me go for a small cap fund. That is how she starts. She learns, and if she is not very confident, she should consult a distributor,
Okay.
because she's still too early for an RA.
How smart are the content providers or those who provide guidance on the net? There are different. I'll give you different categories. One is the Twitter handle. The second is the YouTuber. The third is the blogger. The fourth is somebody who runs a fund research business. Yeah, that's also a business, right? So there are 4 different options. Now, how does a person decide whether he should go to these 4 people or go to a guy who's a 5th guy who is a distributor? How do you make this choice? Because there is a strong feeling in the minds of people that you should not pay any money for anything. Okay, so that feeling is very strong. Let's accept that. What's the downside to that feeling, and what's the downside to these 4 categories, and what's the downside to the distributor? And please tell me the upside also to all 3 things.
Okay, so take my case. I'm a blogger. So what I can say is generic. Right? I can, like I said, this girl should go and invest here. But specifically, I may look at her and say, no, but your father has an illness, you need medical, and your father can't get insurance. So maybe you need 1.5 lakhs of contingent money or emergency fund and not 72,000, which I said generically. People have to understand that whether it is a journalist or a blogger or even a YouTuber, anybody is giving generic gyan, right? It is not specifically made to you. So what I give you is specific to you, right? There is a big difference between generic advice and specific advice. Generic advice is you should eat healthy food, etc. But when I find that you have a lactogen problem, then I will make sure that there is no milk in your food. I don't know you. So that is the difference, and it is a huge difference. And a blogger, I can change my mind tomorrow. I am free. Remember that. I am free, so I can change my mind. I can do a post saying why you should invest in an index fund. I can do a post why you should not invest in an index fund. What will you do with both the advice? And both are right. For some people, index fund is great. For some people, index fund is not great. Right? So whether it suits you, how will you know? How will you know the suitability? So taking generic is good, but you need specific advice at that stage of your life, unless you're going to put money in an index fund. As long as you stick only to a term insurance, a simple medical insurance and index fund, you don't need any advice. And if you have the discipline to say every rupee will go only into an index fund for the next 30-40 years, you may not need an advisor. You may still need an advisor to tell you which credit card to take, whether to take a credit card, whether to take an educational loan, whether to take a home loan. You may need some advice on the borrowing side, but on the asset side, you may not need. But you need the discipline to know not to buy a
So if you want to rise above the index, then
Yes.
you are saying that you need an advisor.
Yes.
Generic advice, be it blog or video or Twitter, is not going to work.
It's not going to be enough.
It's not
It's
going to
very
be-
broad.
Okay. It's not the most efficient thing. Now, when you say go to a specific advisor, maybe now the word advisor itself has got narrowed. Let's say somebody who can give you a recommendation and a rationale and also understands how you should handle this investment during the period of holding, right? So somebody should know the entire, give you a 360-degree service during this period.
Including taxation.
Including taxation, right? So what about the cost benefit? Most people are very upset that, oh, I am giving him some percentage. Could be maybe 1.5%, something like that, as a commission during the tenure of the investment. Do I really need that? My decision is over when I make the investment. So if I can somehow get the necessary inputs here and there and put together the decision, I don't need anybody. So why would somebody go to a distributor, and what should they expect from the distributor?
What they should expect from the distributor is simple hand-holding initially to do the KYC, etc. If you are not very tech savvy or your parents are not very tech savvy. and you want
KYC
to
is
invest-
done.
I mean, basically KYC, filling of the form and making sure that the monthly debit is happening, and maybe getting the annual statements. And suddenly, if you decide to remove money after 11 months, he should at least or she should at least tell you, just wait for one more month, you will pay lesser tax. So basic advice is what you should expect. It's like, a running coach. Initially, you just need a running coach who would say, it's 6 o'clock, get up, go for a run. You don't need anything beyond that. Then you get more advanced. If you're 50 years of age and you have, say, 5-6 crores of assets, and then you're worried about asset allocation and all this. But a young girl, 22 years, doesn't need all that kind of a help. So,
Hand-holding.
Hand-holding.
That's the distributor.
And look at it this way. When you say 1.5%, it looks ridiculously high when the corpus is 10 crores. But at 5,000 rupees a month, it means 75 rupees. In a year, it means 900 rupees. Believe me, in absolute terms, that's not a killer.
Right.
That's not the killer. The killer is something else. The killer is you stopping, or you removing on March 20th when the market falls, you remove the money. Those kill you. 900 rupees a year on 60,000 rupees of investment is not the killer.
Okay. So you're saying that's not the issue. So it's made out, the case is made out in a different way. Now, what about the school of thought? Array, ditch this index, that's for babies, ditch mutual funds, they are for people who don't have high return appetite. Straight, the big game, let's play stocks. And let's start the account and start buying. I can start the account in 10-15 minutes. Why should I not go straight into stock investing, stroke trading?
Good question, but you have to know who is going to tell you which share to buy.
I'll go to the net. I'll follow the popular handles. I'll follow the free portfolios. There's so many things available. I'll go to small case. I'll do it on my own. Why should I not do that as the starting point?
Because there are 9,000 companies. And whatever research we have done over so many years, I don't think more than 200 have created shareholder wealth over long periods of time. The probability of picking something within this 200 to outperform the index, remember you have to outperform the index because the simple option of the index fund is available. To pick a share which will always outperform the index over the next 10 years is not going to be easy. There are so many fly-by-night companies. And again, the general belief that if I buy a good company and hold for a long period of time, I will make money. Not true. In 2000 boom, if you had bought Wipro, which is a great company, no doubt about that, you wouldn't have made money till maybe 2015.
Why? Tell me why.
Simply because you got the timing completely wrong.
And what was it that I could have done differently instead of buying Wipro then? And what is the mistake basically? It's a great company,
Correct.
Stood the test of time,
Correct.
Converted itself from vegetable oil company, the folklore, you know the Wipro.
Yeah, it's a great company, no doubt.
Great company, great management, everything good. But 12 years, 2000 to 2012, people hardly did anything. Why do you think that can happen to me if I'm 22 and going and buying the popular stocks of today, which everybody talks about? Why can't I buy the levers and the Nestle's and the Pidilites and the Asian Paints of the world? And do you think that the Wipro thing can recur?
I don't see why it can't recur.
Okay.
Especially when you're buying a share which has done very well by the last 4 or 5 years. Let's say the company has given you 48-50% return in the last 2 years. And on an average, this company gives you 12%. You can have 4 years of zero. So to catch up with this, catching up with the mean would happen, and then you would make money. Maybe in the 7th year you would make money. What happens if you run out of patience in the 6th year? Remember, you're alone. You don't have anybody to ask. This girl whom we are talking about, her parents have never invested. So where does she turn to? She again turns to the Twitter handles and all that, who have by now abandoned it. Because this company has done nothing last 3-4 years, so the momentum players are not talking about it. Nobody wants to talk about it.
They will try to find something else.
They will be finding something else, and that time you wonder saying, oh, everybody's got out, I made a mistake, let me get out. So you make 2 mistakes, buying at a high and selling at a low. And it's very common to see retail investors.
So you're saying that
both these
the best
mistakes.
of companies, if you end up buying high end, you can end up selling low. That's
Yeah,
a risk.
Reliance has gone through 6 years of
And
no
then,
performance.
yeah, so there is no guarantee that as a very early stage investor, one can control risks so smoothly because you have other pressures, work, so many other things, time, there are many constraints. So given these constraints, you're saying stick to index plus mutual funds, grow your corpus to a particular stage, and then
keep learning.
Keep
learning. Imagine you are, let us take the same girl. Parents have never invested. Parents have only kept in bank deposits. This girl has invested in the share. That share goes nowhere for 4 or 5 years. Her father would just pester her and say, if you had kept it in National Savings Certificate, this would have doubled. If you had got an LIC policy, this would have happened. They would push you with so much of data that the girl could be under tremendous pressure and she would remove exactly at the worst time.
Right.
This is like buying Lupin at 700, selling it at 70. People have done it.
That's happened in the
good
companies also.
Good company. Lupin is a good company.
So buying stocks at any price, which now is called BAP, buy at any price, is a risk in direct equity, and the investor doesn't know whether they're taking that risk. So it's better to stick to products or index. That's your basic advice. But how does one control the temptation? Because it's so easy to buy shares today. Is that actually a boon or a curse?
Two things have happened, Shyam. Technology has ensured that trading is very easy and investing is very difficult. When we were young, both were difficult. But today, trading has become very easy. You get a relationship manager who will say, buy this, buy that, you lose money. Then they'll give you more ideas how you recover the loss. And that stage, this girl would be so scared to tell her father that she has lost money. So she'll keep on putting good money after bad money till she reaches a stage when she has lost maybe a lakh or two, her net worth has come to zero. And then she would say, oh my God, let me stop. Until then, you have bled. The house is never wrong. The house has made money. You have not made any money. This must be true for very many players.
I'm going to shift from investing in popular stocks in a popular way through popular methods to in speculating, because today young people think I'm making income of 50,000-60,000. Let me do trading and I'll make another 30,000-40,000. Some people think I'm making 30,000 salary. Let me do trading. I can make 50,000 in that. And after a while, they think they'll stop working and do only trading.
Full-time.
Full-time trading. A lot of young people have this in their mind as a goal, as some kind of a GPS. And then they also say that it's a waste of time doing things in the real world. Yeah, doing a proper job which is productive. I'll just be a speculator. Technology, the way it enables speculation, is unbelievable. I mean, there is nothing to stop you from buying, to stepping on a landmine, right? That is why we saw what happened in the Yes Bank, where a lot of young people bought Yes Bank and they lost a lot of money. But last 1 year, in a secular market rally, in a rising market, everybody has made money in trading. So everybody thinks trading is easy and they think they have the tools to trade. What can go wrong for somebody who thinks I have the tools and I have done it? I have made money in the last 1 year. What can really go wrong? Why should he, go and try doing indexing and buying larger mid cap, which to him seems like cycling when he can drive a KTM.
Yeah, KTM, right.
Why should he get off the KTM?
Yeah, simply because people like me have seen 1993 when my income fell 95%. My portfolio was wiped out. I mean, thanks to Harshad or whatever. I'm not blaming Harshad. My greed combination, we lost money. But we had the patience to come back. Now, I don't know whether these people have the patience. Some bad learnings have also happened. If you take 2008, 2017, 2020, the recoveries have been V-shaped.
Correct.
So there is now a story going on. When the market falls, keep buying more.
Okay.
You can't go wrong.
Okay.
So, but tell me one thing. What would be your mental makeup if something like a looping were to happen? 700 to 70. At what stage will you sell off everything? And you don't have an answer if you're a young investor to know how much is your risk ability. So your parents will put pressure, everybody will put pressure, and you will sell at the wrong time. Maybe.
No, I'm talking about trading in options. Because that's what is the risk in that?
The risk is you lose your capital.
That's it.
And the worst thing is your relationship manager will keep giving you new ideas.
No, now they don't even, this category of investor doesn't have a relationship manager.
No.
They talk to the phone.
Correct.
The phone, they have a relationship with a portal and a phone.
Or a bot tomorrow. You never.
They don't have any relationship with anybody.
Oh.
And they source information online and do trading.
Execute online.
So it's the whole ecosystem is an online ecosystem. So you are saying that, if you do that, you are alone and you don't know what can happen to you.
Largely, investment is about maybe 5-10% of technical skills, and 90% is emotional skills. We have all gone through that. We bought a share which has crashed and then come back. We have bought a share which has crashed and never come back.
Correct.
We have done all those things. We have invested in companies.
Have gone bankrupt.
Yeah, we have invested in a company where there is one key man, he has died, and the company has been brought to ruin by the next generation.
Correct.
We have done all that. what gives us strength is being able to talk to somebody about it and see what is happening and then take a decision. Maybe you got the share at $200 and you got out at 120 at a loss, and then had the mortification of watching it go down to zero, and you said, wow, I lost only 80 rupees, or I could have lost 200 rupees. And that happened because at 120 you spoke to some banker or some broker who said, boss, this company is getting into a mess, the family is fighting, better to sell off. I remember such cases, right? So we've all seen such cases. Families have ruined business.
So you're saying a young person should stick to a narrow set of choices, get the right handholding till the corpus reaches a certain stage, learn a lot during that period.
Yes.
When the corpus
Yes.
slowly inches up to a particular point.
Yes.
Give themselves a lot of time to learn, not be in a hurry to demonstrate what they have learned, and probably try their hand at picking stocks directly when they are in a bear market, not at the time the valuations are high.
I would think this chart of putting money in an index fund and create 2-3 phantom portfolios. You create it at home. You buy Asian Paints, HDFC, and create a portfolio of 10 lakhs. Create another portfolio of 10 lakhs and another portfolio of 10 lakhs and start journaling. Say why you bought Asian Paints, why you bought Pidilite, why you bought HDFC Bank. That should also say why you did not buy Jensen Nicholson, right? Why you did not buy
Shalimar Paints.
Shalimar Paints. All that you start writing down, believe me, you will become a great investor. Because the process of learning, once you put that in place, we put the process in place and you know what you're learning from where, from which book, can make you a good investor. We have all done that. We have not gone through, I have not gone through any course in investing. But if I can shrink my 20-30 years experience and shrink it to a few books, and you can read and learn and then implement, you will be better off.
Closing comment, any word of caution?
Look at so many companies which have failed. Look at so many investors who have failed and keep your head on your shoulders. The company doesn't even know that you exist. You know that you have bought a SAIL or ONGC or HDFC Bank or Asian Paints. Company doesn't know you. Don't get emotionally attached. Having said that, a lot of us are emotionally attached to shares which have created wealth for us. So I'm contradicting myself in the first part and the second part. You have to emerge from all these conflicting, contradicting learnings from different books. John Templeton's style, Warren Buffett's style, and George Soros' style was very different. All three were brilliant investors. Samir Arora is different from Prashant Jain. Prashant Jain is different from Naren. Naren is different from Anand Radhakrishnan. But largely these three people follow the value system. Learn, read, write, understand, put the process in place, and then become a good investor. You cannot become... Investing is not just signing a check, right? I love what Sam Manekshaw said. A 4-day war requires 361 days preparation. Buying is very easy. Selling is very easy. The process of why you are buying what is 360 days to do 4 days of trading.
Thank you, Subra. That was a breezy 360-degree view for a small investor. I hope those who are watching this video take your advice seriously and stay in this market for a very long time to benefit.
Yeah, it is
from the
N.
asset.
It is N which makes money. R is almost incidental. Warren Buffett has made this much money because he started at 11 and is alive at 91. 80 years of compounding.
Amazing.
You need that.
Thank you so much, Subra. Thank you.
My pleasure.